students, welcome to the lecture on concept of time value of money, and after this lecture we will be able to learn the following objectives. Explain the reasons for time value of money, discuss the cash flow is better than PE, define the future value of single cash flow, explain the future value of annuity, understand the present value of single cash flow, explain the internal rate of return IRR, and discuss the project selection and evaluation. Reasons for time value of money. Let us begin our lecture with money. Money has time value. A rupee today is more valuable than a year. Hence, it is on this concept the time value of money is based. Value of money is different at different points of time. Since money can be put to productive use, its value is different depending upon when it is received or paid.
The goal of this presentation is to explain what is time value of money, why we study time value of money, 5 models of time value of money, and its applications. Time value of money simply suggests that money in your hand today is worth more than money you will receive at a later date. The reason the money you receive today is worth more is because money does not grow on trees, and there is a cost for money, which is the interest payment on borrowed money. In business, the money is raised either by debt or equity, and it costs the company to raise money either by debt or equity. Let's assume that someone is offering you $10,000 today and $10,000 after 2 years. What would be your preference? You would select $10,000 today because the money in your hand today worth more than money you will receive at a later date. If you have to receive $10,000 today and deposited the money in an interest-bearing account at 5% for next 2 years, you will have $11,025 in your bank account by the end of 2 years. The value of $10,000 that you have in your hand after 2 years is $11,025, which is greater than $10,000. That's why you would prefer $10,000 today, not $10,000 after 2 years. If you ignore the time value of money concept, you will not be able to make good personal or business decision. Let's take an example. You invested $1 million in an investment account today, and the investment is going to generate $1.2 million at the end of the 2 years. Based on the information, you assume that project is going to generate $200,000 in profits. Problem with this assumption is you have ignored the time value of money. If the cost of borrowing was 12%, you're going to lose money in the project. Let's assume the initial investment is $1 million, interest cost is $240,000, and the investment value at the end of 2 years is $1.2 million. The loss from the investment is $40,000. The 5 models of time value of money are future value, future value of annuity, present value of annuity, and loan amortization model. The future value is a compounding process, which means as the time and our interest rate increases, value increases. The present value is a discounting process, which means as the time and our interest rate increases, value decreases. The future value and the present value models are used for single sum, and when you have stream of payments of equal amount and equal interval, future value of annuity and present value of annuity models are used for time value of money analysis. Amortization model is used for loan analysis. The first step in time value of money analysis is to draw a timeline to clarify the analysis on hand. Period 0 on the left hand side represent value today, which is present value, and any time period on the right hand side is future period, which is future value. This is a timeline for future value because it involves single sum and question mark is on the right hand side. This is a timeline for present value because it involves a single sum and the question mark is on left hand side. This is a timeline for future value of annuity because it involves a stream of payments of equal amount at equal interval and the question mark is on the right hand side. This is a timeline for present value of annuity because it involves a stream of payments of equal amount at equal interval and the question mark is on left hand side. 3 variables in time value of money analysis are interest rate, number of periods, and future value and present value. Using the 5 models presented earlier, you can solve present value of annuity, present value of annuity, payments, or you can solve for interest rate and time period. Let's assume you have invested $100,000 in an investment that guarantees 10% annually, how much money will you have in your investment account after 5 years? First step is to draw a timeline for time value of money analysis. Time period is 5 years. Money is deposited at period 0. Interest rate is 10%, and the question mark is on the right hand side. It is a future value analysis. Let's use a financial calculator, Texas Instrument or HP, and enter the data in the following order. Enter 5, press N key, enter 10, press I/Y key, enter 1000, press plus and minus key, press present value key, enter 0, press payment key, press compute key and future value key if you're using Texas Instrument, or just press future value key if you're using HP. The answer is $1,610.51. If you invest $1,000 at 10% for 5 years, at the end of 5 years, you will have $1,610.52 in your bank account. Let's assume you will receive $5,000 after 5 years from a trust account. The question here is, what is the value of the trust account today, assuming that the annual interest rate is 10%? Draw a timeline for time value of money analysis. Time period is 5 years. Money you will receive after 5 years, which is the future value. Interest rate is 10%, and the question mark is on left hand side. It is the present value analysis. Let's enter the data in the calculator in the following order. 5N, 10 I/Y, 0 payment, 5,000 future value. Press compute key and the present value key for Texas Instrument, just present value key for HP. The present value is $3,104.60. This is the present value of $5,000 that you will receive after 5 years in today's dollar. Let's assume that you are depositing $1,000 every year in an investment account for next 5 years. What will be the balance in your investment account after 5 years, assuming that the interest rate is 10%? First, draw the timeline for the time value of money analysis. Time period is 5 years, depositing $1,000 every year for next 5 years, which is payment. Interest rate is 10%, and the question mark is on the right hand side. It is a future value of annuity analysis. Let's enter the data in the calculator in the following order. 5N, 10 I/Y, 0 present value, 1000, then plus and minus key, then payment. Next, press compute key and future value, or for HP, just press FV, future value. The future value of $1,000 deposits for 5 years is $6,105.10. Let's assume you will receive $1,000 every year for next 5 years from a trust account. What is the value of 5 payments that you will receive in today's dollar, assuming that the annual interest rate is 10%? First step is to draw the timeline for the time value of money analysis. Time period is 5 years, depositing $1,000 every year for next 5 years, which is the payment. Interest rate is 10%, and the question mark is on the left hand side. It is a present value of annuity analysis. Let's enter the data in the calculator in the following order. 5N, 10 I/Y, 1000 payment, 0 future value. Press compute key and PV for Texas Instrument, just PV for HP. The present value of $1,000 deposit for 5 years is $3,790.78. Let's assume you're borrowing $25,000 to buy an automobile, and you will be paying back the loan in a monthly installment over a period of 5 years. The question here is, what will be your monthly payments assuming an interest rate of 6%? This analysis involves non-annual compounding. The rules for converting annual data into non-annual data are: number 1, multiply the number of years by number of compounding or discounting period in a year. In this case, we have 5 years. There are 12 months in a year, so 12 times 5 is 60 periods. Rule number 2, divide the given interest rate by number of compounding or discounting period in a year. In this example, the interest rate is given to you 6%. There are 12 months in a year. 6% divided by 12 is 0.5%. Draw a timeline for time value of money analysis. Time period is 60 periods. Borrowing today is $25,000, which is present value. Interest rate is 0.5% monthly, and the question mark is on payments. So we are solving for payment. It is a loan amortization analysis, which is same as present value of annuity analysis. Let's enter the data in the calculator in the following order. 60N, 0.5 I/Y, 25,000, then plus and minus key, then PV key, 0 FV, press compute and payment for Texas Instrument, just press payment for HP. The monthly payments for $25,000 loan for 5 years are $483.32 per month.
Money has time value because of the following reasons. Risk and uncertainty. Future is always uncertain and risky. There is no certainty for future cash inflows. Inflation. A rupee today represents a greater real purchasing power than a rupee a year hence. Consumption. Individuals generally prefer current consumption to future consumption. Investment opportunities. An investor can profitably employ a rupee received today to give him a higher value to be received tomorrow or after a certain period of time. The fundamental principle behind the concept of time value of money is that a sum of money received today is worth more than if the same is received after a certain period of time. Timelines and notation. Timeline shows the timing and the amount of each cash flow in cash flow stream. Cash flow is better than P upon E. Option: cash flow is better than PE. Cash flow ratios are a better measurement of a stock's value than price earnings ratio, P by E. The PE represents the ratio of the stock's price to its earnings per share, EPS. When a company's PE is very high or low, it gets top billing on the news. But the PE ratio has its own limitations, especially in the emerging economy. For one, this ratio is susceptible to accounting jargon, and secondly, this ratio is overtly biased in favor of low-income, high-growth companies. Discounted cash flow, DCF. Discounted cash flow, DCF analysis uses future free cash flow projections and discounts them, most often using the weighted average cost of capital, to arrive at a present value, which is used to evaluate the potential for investment. Advantages of discounted cash flow. The DCF method is forward-looking and depends on more future expectations rather than historical results. The DCF method is more inward-looking, relying on the fundamental expectations of the business or asset, and is influenced to a lesser extent by volatile external factors. The DCF analysis is focused on cash flow generation and is less affected by accounting practices and assumptions. The DCF method allows expected operating strategies to be factored into the valuation. The DCF analysis also allows different components of a business or synergies to be valued separately. Disadvantages of discounted cash flow. The accuracy of the valuation determined using the DCF method is highly dependent on the quality of the assumptions regarding FCF, TV, and discount rate. Valuation is largely dependent on TV assumptions rather than operating assumptions for the business or the asset. Importance of cash. The reality is that without cash, a company would not last long. Price to cash flow. The price to cash flow is determined by dividing the stock's price by cash flow per share. Free cash flow. Free cash flow is a refinement of cash flow that goes a step further and adds one-time expenses, capital expenses, dividend payments, and other non-occurring charges back to cash flow. Future value of single cash flow. The future value of a single cash flow is its value after it accumulates interest for a number of periods. The future value of a series of cash flows equals the sum of the future value of each individual cash flow. Future value of annuity. The equation here calculates the future value of a stream of equal payments made at regular intervals over a specified period of time at a given rate. This value is referred to as future value FV of an annuity. Price cash flow ratio is equal to stock price per share upon operating cash flow per share.
In this video, I'm going to show you how to calculate the future value of an annuity. An annuity simply is a series of equal ongoing payments that we would contribute to a particular investment. It's very, very common, particularly with 401ks and 403bs, where not only do we invest an initial lump sum into an investment, but we also contribute a series of ongoing payments. And a lot of times those can be in equal amounts because typically it's a percentage of our annual income. And so what I'm going to do is show you how to calculate that using a longhand method that we would use to calculate for such a future value of an annuity. It's a very, very simple process. It can be quite tedious. One thing I will say is if you have not seen the prior video that I posted with regards to calculating the future value of an investment, I would encourage you to review that because we do build upon some of that material. It's very brief, only approximately 5 to 6 minutes, and it'll definitely catch you up to speed so that you're ready to go for this particular problem here. So the first thing that we need to do is we need to figure out ultimately what we're going to invest. If you remember from last time, we've talked about the different types of variables that we need to consider with regards to calculating future values of investments. The first thing that we need to know ultimately is what is going to be our present value. What is the amount that we're going to contribute today to our particular investment. And so let's just say that the present value of our investment is going to be $10,000. That's the money that we're going to contribute today to this particular investment. We also need to know ultimately how long we're going to invest our monies. And so let's just say that we're going to invest this for 5 years. And as far as interest rate, we're going to assume that we'll earn a 7% interest rate compounded annually. Now so far this is very similar to how you would calculate the future value of a lump sum investment. The difference though is that we have to deal with that series of ongoing payments that we're actually going to be making. And so we abbreviate that as PMT. Some methods are also abbreviated as C, which stands for generally cash flow. PMT is a common abbreviation, and actually it's a symbol usually on most financial calculators. So I use that just for consistency purposes since you usually see it across different forms. So let's assume that our payment, or what we're going to pay on an annual basis, let's just say that's going to be $1,000. And so we're going to invest $10,000 initially, contribute $1,000 every year for 5 years, earning an interest rate of approximately 7% compounded annually. So let's go through ultimately how we would solve this particular problem. First thing I want to do here, and what we need to do here first is kind of draw out just a basic line here, because we're going to chart our payments. And so I'm going to start with a line just going all the way across here. And then what we're going to do is put some hash marks here to symbolize the first today, the first period, second, third, fourth, and then that last period. And if we want to, we can go ahead and even abbreviate each one and list what they are, just so there's no confusion. Now what we want to do also is we want to list when each of the payments are going to be made. This helps us be very, very organized so that we ultimately can get to the right answer, which is what we're after. And so in the 0 period, which stands for today, we are going to be putting in our $10,000. Okay. In the first period, which is in the first year, we're going to be investing $1,000. And we're going to do that the same thing for years 2, 3, 4, and 5. Okay, and I'm going to show you ultimately how this plays effect. Now what we have to do is we have to ultimately compound these to that 5th year, because that's where we're ultimately trying to figure out how much money we end up after that period of time. And so the first thing that we start with, we always start with the latest or closest to that 5th year. So we're going to start in year 5. We already are going to contribute $1,000. And so this one's going to be quite easy because we're going to calculate basically the future value of a lump sum investment. That's how we're going to treat this as. And so we're going to take our $1,000 and we're going to multiply it by 1 plus our interest rate of 0.07 to the nth power, which in this case is going to be 0, because we're investing it in the 5th year, so it's not going to have the time to actually grow. And so here, we're actually just going to go ahead and get our $1,000 back. And so we're not really getting anything with this particular investment, which is fine. We just put the money in, so we're not allowing it time to grow. It will grow in subsequent years, assuming we leave this money in the investment. But let's do the same thing for each of these periods here. And so first we're going to take our $1,000 in year 4. We're going to move this over, and we're going to do the same type of equation, the future value of a lump sum. And the only difference here is that we're going to change the period, which is n. And so instead of being 0, this is actually going to be 1. And so we're doing 1 plus 0.7 to the first power times 1,000. And if you do that quick calculation, you're going to find that we end up with an end result of $1,070. Okay, a little higher than before. We do the same thing in year 3. So we're going to take this over. We're basically going to compound this for 2 years. Since we're already in year 3, we have to compound this for 2 years because we're going once to year 4 and the next we're going to year 5. So that's 2 years right there. So let's go ahead and work out that problem. So let's take 1,000, just like before, times 1 plus our interest rate of 0.07, and this is going to be to the second power. And that's going to get us $1,144.90. Okay, and then next we're going to do that with year 2. And you can see kind of while I'm calculating this, just how tedious this becomes and how why you would utilize the equation if you had more than just a handful of years, because this can get to be a rather long process as I'm kind of going through this here. But it's important to understand simply how the process works, and then you can use the formula, and at least you can understand ultimately how you got there because you know how to work out the problem by hand, which I think is very important. And so the last one here we have is year 4. We're going to do that same process here, bring that $1,000 over. We're going to go to the 4th power, and that's going to give us $1,310 as well as 80 cents. And so we're almost done here actually. You can see that we have quite a bit of information already. And the only thing that we need to do left, and we're going to move this up a little bit just so we have some more room. The only thing else we need to do is we need to actually take our $10,000 and we also need to compound that to the 5th year. And so we're going to move this over and do the same exact thing that we did with the other numbers before. And so instead of being 1,000, it's going to be 10,000. And we're going to add that to 1 plus our interest rate of 7% to the 5th power. And that's actually going to get us $14,025.52. And so the last thing that we need to do actually is just go ahead and add all these together. So we're going to draw one line right here and then ultimately add all of our future value cash flows that we have. And so if you add all these together, what you do get is a final value of $19,776.26. Okay? Let's make sure that's a 9. And so what this would mean is that if we invested a $10,000 lump sum initially, $1,000 on an annual basis for 5 years, assuming that we grew our interest or grew our investment at 7% compounded annually, we would actually end up with $19,776.26. Now the beauty of this particular format or form of solving this problem too is that you can also assume that your cash flows are different. We assumed that they were ongoing but also the same amount, and you can have inconsistent cash flows where maybe in year 1 we invest 1,000, maybe in year 2 we invest 1,500, maybe in year 3 it's a little different. And so using this type of form to actually solve that problem, you can change those figures and ultimately compound those by the number of years that you need to ultimately get to the right answer. There are also a number of ways to solve them using financial calculators, which of course if you're going to use a financial calculator that is by far the easiest way of doing that, and they are fairly easy to use. But this is ultimately how you would calculate the future value of an annuity utilizing the longhand method.
The future value of an annuity formula assumes that the rate does not change. The first payment is one period away. The periodic payment does not change. How is the future value of an annuity derived? The future value of an annuity is the future value of a series of cash flows. The formula for the future value of an annuity or cash flows can be written as equal to P plus P, bracket open, 1 plus R, bracket close, till P, bracket open, 1 plus R, bracket close, n minus 1. Present value of cash flow. Cash flows can come in a mixed stream or a pattern of equal annual flows or even a perpetual stream. Mixed flows, equal flows, constant growth. Mixed flows. To compute the present value of a mixed stream, a spreadsheet is invaluable. Equal flows. The most straightforward application of the DCF method is when expected cash flows will be received in equal payments during the time period in question. Constant growth. A company grows and becomes more successful, its dividend payments will also steadily grow. Present value of single cash flow. There are three approaches to solving the problem of calculating the present value of a single amount. You can use the present value of a single amount formula. You can use a financial calculator. You can use a spreadsheet application such as Excel. The present value of a single amount is the exact opposite of future value. Here is the formula. PV is equal to FV in bracket 1 upon in bracket 1 plus I bracket close T bracket close. Internal rate of return IRR. The internal rate of return or IRR is the average annual return generated by an investment over a specific number of years from the time the investment is made. IRR can be used to rank several prospective projects a firm is considering. The higher a project's internal rate of return, the more desirable it is to undertake the project. The IRR is effective when used as a comparative gauge for analyzing several investment options. Investments having higher IRRs are preferable to those having lower IRRs. Implication of IRR under different conditions. When an investor, which might be an individual or a company, analyzes the viability of a prospective investment, such as a stock or a client project, the investor is interested in that investment's net present value NPV. The NPV is an arithmetic function that expresses something's estimated future value at the present time. The internal rate of return is the rate that would, in theory, make an investment's NPV equal to 0. Net present value. Net present value, as part of which internal rate of return is expressed, is the value today of an investment's possible future returns in terms of its net inflow of cash when subtracted from the cost of the investment. Project selection and evaluation. Whether the method issued in manufacturing or service organizations, the future of a deployment is always influenced by the quality of project selection. Project selection typically starts with generating ideas. Methodology for idea filtration. Once project ideas are collected, they need to be evaluated further to determine if they fit within the organization's critical parameters. To increase the chances of success, all ideas generated for projects need to be evaluated on 4 parameters: linkage with organizational importance, feasibility of execution, organizational buy-in, organizational benefit. A questionnaire can be used to test how well ideas fit within the 4 parameters. For example, linkage with organizational importance. Is the idea linked with the business objective and priorities of the organization? Is the idea linked with the process-specific pain? Is the idea linked with internal performance measures or a service level agreement with a customer? Feasibility of execution. Is the solution to the problem already known? Is data available for understanding the current magnitude of the problem? Is a system available for capturing data? What is the repeatability of the process to which the idea is linked? Is the idea linked with multiple sub-processes? Does the process linked with the idea require client or customer approval before making any changes? Organizational buy-in. Is the champion interested in pursuing the idea as a project? Are suitable resources available for carrying out the idea as a project? Summary. Now in the end, let us summarize what we have learnt in this lecture. Financial decisions such as the purchase of assets or procurement of funds affect the firm's cash flows in different time periods. In an inflationary economy, the money received today has more purchasing power than the money to be received in future. Cash flow ratios are a better measurement of a stock's value than price-earnings ratio (PE). Free cash flow is a refinement of cash flow that goes a step further and adds one-time expenses, capital expenses, dividend payments, and other non-occurring charges back to cash flow. The discount rate often used in capital budgeting that makes the net present value of all cash flows from a particular project equal to 0.